Hey, so welcome to the very first episode of Financial Engineering with Queens. The title of this episode is The Guts of Global Finance and Default. Enjoy!
The western focuses of Texas and California shelter me away from the wastelands of Americana. Or will they tear my commie pussy apart? Oh no, no, because I wouldn't mind riding Joe Stalin's banana.
Welcome back, you financial phenoms, to the deep dive. Today we are strapping in, honey, and getting ready for a very high-octane journey through the absolute guts of global finance.
We really are. We're pulling focus on, well, everything from the microscopic, like the tiny little details of market data and risk modeling.
All the way up to the big picture systemic dangers, leverage, ethical failures, the whole dramatic mess.
Exactly. And our sources today are, let's just say dense. They cover core finance, market structure, computational analysis. It's a lot.
It's a lot. It's like a stack of textbooks higher than a drag queen's finale wig. But our mission, as always, is to take all of that and just
Hey there. Want to
Yeah.
share your thoughts on this?
Yep, and halfway through the show, we'll also be reading some of the messages sent by our listeners. So please stay tuned for that. They might get messy, so you guys please have fun in there.
Thank you so much for that excellent interjection. We absolutely love hearing from you.
Yes, and we love that idea. Reading your messages midway through is a great break.
That kind of conversational structure is actually really interesting to us.
Right. It's like a side sequence in conversation analysis.
Exactly. It interrupts the main thread of discourse, the deep dive content, but it's totally relevant.
It's what's called an acknowledgement or a back channel token.
It signals engagement and ensures grounding, which is essential. We'll definitely set aside time for those messy messages.
So we'll plan to pause right after Act 2, after we've discussed the data quality drama.
That's a perfect spot for it before we move into the more abstract modeling discussion in Act 3,
Distill the absolute most crucial tea and serve it right up.
giving you the shortcut to sounding incredibly well-informed at your next cocktail party.
Or your next hookup. You never know. We promise to keep the energy high and the discussion, sharp.
So we've structured this dive into 4 critical acts. First up, we have the foundations of risk and return,
We're nailing down the basic math of value and volatility.
the fundamentals. Then Act 2 is reading the tea. And this is where we get into the messy, non-frictionless reality of financial data.
All the errors, all the drama. I live for it.
And then, as promised, we'll pause for those listener messages right after Act 2.
Then Act 3 is the library is open, where we look at how advanced models like vector semantics and all that fun stuff try to clean up that mess.
And finally, a truly gag-worthy finale, Act 4, the drag of default.
We're talking about the catastrophic power of leverage, how to vet your financial partners, and the eternal problem of people just being messy, moral hazard.
It's a journey. We've got math, we've got market drama, and we've got high-stakes failure.
Okay, let's unpack this. Let's go deep. So we have to start with the essentials, right?
Because finance at its core is just a system of valuation.
And the most fundamental concept, the absolute bedrock, has to be the time value of money. TVM.
So why should I always prefer a dollar today over a dollar that's promised to me, like next year?
I mean, it's because the dollar today just has more utility. You can do stuff with it.
You can put that money to work right now, earning interest,
Okay.
which means any money you're promised in the future has to be what we call discounted back to the present.
To figure out what it's really worth today, it's the cost of delayed gratification.
It's like, if I lent you $20 for the night, I can't use that $20 to buy a drink.
So when you pay me back, you better be buying me a drink too.
That's basically it. You're losing the opportunity to invest that money.
So you have to be compensated for the lost earning potential. And the way that potential grows is critical.
Right. So we have to distinguish between, simple interest and compound interest.
Simple interest is the basic kind of vanilla calculation. It's just a percentage applied to the initial amount you invested, the principal.
Simple interest is fine. It's the missionary position of finance.
It gets the job done, but it's never going to fund your retirement in Mykonos.
Exactly. It's predictable, but it's not a game changer. The real star of the show, the headliner, is compound interest.
That's where your interest starts earning its own interest? Ooh, now we're talking.
And the really critical factor here is the compounding frequency.
If interest compounds monthly or quarterly or even daily instead of just annually,
It's better, right? So much better.
that higher frequency results in a significantly larger, more valuable sum over time.
Your principal is constantly growing, and you're earning interest on those new tiny amounts of interest. It's exponential growth. That's the engine.
That is the financial glow up we are all looking for.
It's like turning a small investment in a great first date into this like massive compounded relationship fantasy.
Mm-hmm. But looking at that time element, the longer you wait, that introduces a ton of risk, doesn't it?
If I loan someone money for 5 years versus 5 days, the 5-year loan just feels so much riskier.
Oh, absolutely. That's default risk and uncertainty in action.
The longer a debt is out there, the more uncertainty there is about the borrowers. Well, their capacity and their willingness to actually pay you back.
Why?
Because more stuff can go wrong. You have more time for external factors to just completely derail their financial situation.
We're talking economic downturns, regulatory changes, or, just personal catastrophes. Life happens.
So it's like the difference between a one-night stand and a long-term relationship.
The one-nighter is low stakes. You expect a quick repayment, let's say.
Right, the LTR, that's high risk. So many external factors can wreck it.
The economy, his weird family, his character suddenly taking a nosedive.
That's a perfect analogy. And because of that, the lender has to charge a higher interest rate on that long-term loan.
They do it specifically to offset that increased probability of default.
The price of the capital has to reflect all that time-based uncertainty.
So that risk premium is basically the lender getting compensated for the possibility that the other person just ghosts them financially.
It has to be priced in. It's a mechanism to pull all that future uncertainty into the present day and put a number on it.
So, okay, if TBM is about valuing an asset over time, then risk is really about valuing the variability of that asset's return, the drama.
The chaos. We love chaos. We do.
And in finance, we quantify risk using statistical metrics.
The two big ones are variance and standard deviation. They just measure how spread out or volatile the returns are around their expected average.
So if I have two investments, right? Investment A and investment B.
They both promise me a 10% expected return for the year.
But investment A has a much higher standard deviation.
Then investment A is the riskier, more volatile choice, right?
It might shoot up to 50% one year and then, boom, drop to negative 30% the next.
Meanwhile, investment B is just kind of reliably hitting that 10% mark. Exactly.
And this brings us to individual risk preferences, because not everyone feels the same way about that volatility.
Investors are on a spectrum. Okay, you've got your risk-averse investor.
This person actively dislikes variability. They are literally willing to pay a premium just to get the expected return with certainty. No surprises.
That is Sam. Sam is the investor who buys blue-chip dividend stocks and wears a turtleneck to the Met Gala.
He wants stability. He hates drama. He absolutely does.
But then on the other end, you have the risk-preferring investor. This person is willing to pay to keep the variability.
They enjoy the gamble. They want the potential for that huge outlier win. That's Rachel.
That is Rachel. Our sources highlight her specifically.
Compared to Sam, Rachel tolerates a lot more added risk for even tiny improvements in expected return.
Her optimal portfolio is going to have much higher volatility assets. Emerging market stocks, crypto, speculative derivatives.
Rachel is absolutely the one who will risk a full-on wardrobe malfunction for a show-stopping gown. She wants the high stakes.
Sam is in his turtleneck, perfectly safe. That's the perfect synthesis. Their utility functions are just different.
Rachel values the potential for that upside excitement way more than Sam values the certainty of just getting the average.
So that standard deviation metric we use, it has a flaw, right? It treats all deviation the same.
It does. It assumes returns are normally distributed, like a perfect bell curve, and it internalizes both positive and negative deviations equally.
Wait, hold on. Why on earth would I care if my investment deviates wildly to the upside? That's amazing. That's the goal.
Exactly. Who's mad about making too much money? Nobody.
That's why we need a better metric for the risk that investors actually truly fear, which is losing their money.
Okay, so what is it? It's called semivariance.
Ooh, she sounds cheek. Spill the tea on semivariance.
Semivariance measures only the downside risk. It calculates the variability of returns that fall below the average or below a specific target, like 0.
It completely ignores all the positive deviations. So if I'm stress testing my portfolio to see how bad things could get, I need to be looking at my semivariance, not just my standard deviation.
100%. Since most investors are primarily worried about catastrophic losses, semivariance is just a superior metric for analyzing the actual safety of a portfolio.
And the data shows this in real-world assets. Like what?
Well, our sources compared Bitcoin to the S&P 500.
Bitcoin's semivariance was 0.000181. The S&P 500's was 0.00021.
Whoa, that is a huge difference. It's an exponential difference.
It tells you that Bitcoin is prone to significantly larger, more frequent, and more devastating negative price swings. The potential for downside is just massive.
Bitcoin is definitely the high glamour, high drama choice that can leave you financially gagging.
That semivariance number is the technical receipt that proves it.
So once an investor like Rachel decides what asset she wants to pursue, she needs to know where to find it.
And this all starts with how companies raise capital, which basically splits the market into two essential spheres.
The primary market and the secondary market. You got it.
The primary market is where new securities get created and sold for the very first time. This is usually during an initial public offering, an IPO.
Right. The firm sells shares directly to the public, and it's usually managed by investment banks.
Exactly. And the funds from that sale go directly to the company to grow the business.
And getting in on an IPO, that's like getting on the exclusive VIP list for a new club opening.
Those shares are almost always allocated first to the big players' pension funds, mutual funds, people with deep pockets and long-term relationships.
Precisely. But the vast majority of trading, and where most of us retail investors participate, happens in the secondary market.
That's the exchanges, right? The NASDAQ, the NYSE.
Yes, that's where all the previously issued shares trade hands between investors. So when I click buy on a stock,
You're not buying it from Apple. You're convincing some existing owner to sell you their shares at whatever their offer price is.
yes, and that's the essential function of the secondary market. It provides liquidity.
Without it, shares would be almost worthless because you could never easily convert them back into cash when you needed to.
Liquidity or marketability is the lifeblood of the whole system.
And how we actually interact with that liquidity depends entirely on our order type.
Let's get into the nitty-gritty. Who's the top and who's the bottom in the order book?
Okay, so the two simplest forms are the market order and the limit order.
A market order is basically you saying, I want to trade right now at the best price available.
You're prioritizing speed. You want it now. Yes, speed and certainty of execution are more important than the exact price.
And because they immediately match against and eliminate a posted order, we classify them as liquidity taking.
They just come in and snatch it. They're demanding they clear the dance floor.
Right. Conversely, a limit order specifies a price constraint.
For example, buy 100 shares, but only at $50 or less.
If the price isn't at or below $50, your order just sits there on the exchange's order book, waiting.
Okay, so it's more patient, very patient.
And by sitting there, it provides a passive counterparty for those aggressive market orders to execute against.
So we call them liquidity making. So wait.
If limit orders have this risk of never even being executed, why would a sophisticated trader ever use one?
Why not just use a market order and guarantee you get it done?
Ah, that is the crucial trade-off. Because they provide that essential liquidity, limit orders are often compensated by the exchange, maybe with a small rebate.
Or, at the very least, the cost of crossing the bid-ask spread, so you get better price control.
Much better price control, even if you sacrifice speed. They are the essential infrastructure that lets the whole market function efficiently.
Without the liquidity makers, the liquidity takers would have nothing to take.
Okay, we've laid out this beautiful, elegant theory of how markets work.
But now we have to get into the messy reality. This whole next act is about market frictions, high-frequency chaos, and the data quality drama that pollutes every single model we try to build.
It's where the fantasy meets the real world.
Classical microeconomics assumes this perfect fantasy world, a frictionless marketplace.
What does that even mean?
It means zero transaction costs, infinite liquidity, and information that is instantaneous and totally free for everyone.
Okay, so it's like a perfect app interface where everything is smooth and fast and works exactly like it should.
But in real life, when I try to trade, I have commissions, taxes, slippage. Those are all frictions, right?
Those are all frictions. They're the real world constraints.
Transaction costs, regulations, even just limits on how you can submit an order.
Our sources note that being limited to submitting just one price and one size at a time means that real world prices can absolutely deviate from that perfect theoretical equilibrium value.
So how do markets try to deal with some of that friction, especially around really volatile moments like the market open or close?
They use a structural mechanism called a call auction.
Now, unlike the continuous trading we see all day, a call auction is a periodic, order-driven market.
Think of the New York Stock Exchange opening bell. Okay.
All the orders that were submitted during a specific time window are all batched together.
And they're all executed at the same time, yes.
All at once, at a single uniform clearing price.
And that clearing price is mathematically calculated to be the one price that maximizes the total number of shares that get executed.
So it's like a moment of truth.
It is. It concentrates all that liquidity at one specific moment, which significantly reduces the volatility and the transaction costs.
Compared to just letting it rip with continuous trading right at the open, it cuts through the chaos.
But once that continuous trading starts, the market is just breathing in microseconds.
If the daily closing price is the summary of the day, we need the juicy, granular details. We need the tick-by-tick data.
Tick data is the most granular level of financial data you can get.
Every single event, every trade, every change in a quote is recorded with a timestamp down to the millisecond.
And what does it include?
Everything. The price of the trade, the volume, the highest bid price, which is what a buyer is willing to pay,
The lowest ask price, what a seller will accept, and the volumes available at both of those prices.
This data stream is like digitally stalking the market. It's how we see the real dynamic of supply and demand minute by minute.
And hiding right in between that bid and ask price is the bid-ask spread.
The spread is fundamental. It represents the immediate cost of doing a trade.
From the perspective of the market maker, the institution that's providing that two-sided liquidity, they're making the market.
Right. For them, the spread is their profit margin.
They buy the stock at the lower bid price and immediately turn around and try to sell it at the higher ask price.
Get those coins, they're providing a service, and they're getting compensated for it. Makes sense.
And a tight spread tells you it's a highly liquid market.
Buyers and sellers are very close to agreeing on what the asset's true value is.
But a wide spread signifies illiquidity, meaning it's harder to trade.
Much harder. If the market maker thinks they might have to hold the asset for a while, or if there's a lot of risk, they demand a wider margin to compensate them for taking on that risk.
And this whole idea of liquidity connects directly to the nature of the asset itself, doesn't it?
Like, some things are super easy to trade, and others require a full-on forensic investigation first.
That is the difference between fungible and non-fungible assets.
Fungible assets like gold, shares of a stock, or dollar bills are interchangeable. One unit is identical to another.
So you don't have to do a lot of homework before you buy one.
Exactly. Due diligence is minimal, which makes them highly liquid.
But non-fungible assets, like real estate or fine art, they're all unique.
Completely. Trading a house requires intensive, individual due diligence.
You need a title search, an inspection, an appraisal. You can't just swap one house for another identical one.
And that need for an exhaustive, asset-specific investigation creates a ton of market friction.
It makes non-fungible markets inherently less liquid, and that leads to wider bid-ask spreads and higher transaction costs.
Okay, we have to spill the real tea now, the actual tea.
We can analyze spreads and order books all we want, but if the foundational data we're relying on the historical records is polluted, every model we build is suspect.
How bad is the problem, really? The problem is, extensive.
Our sources confirm that data quality issues are rampant in financial research.
We're talking about everything from simple missing values and typos to really deep-seated biases and inconsistencies across different data platforms.
Give me the receipts. Let's talk about the big platforms that everyone relies on.
Okay, let's start with the two giants for academic research. CRSP, that's the Center for Research in Security Prices, and Compustat.
Early on, researchers did these cross-checks and found significant error rates even in just the core monthly return data.
How significant?
Compustat had an error rate of about 1 error for every 1,000 observations.
CRSP, which is a bit more meticulously curated, had about 1 in 10,000.
Okay, 1 in 10,000 sounds small.
It sounds small, but think about it. Over decades of market activity across thousands of stocks, that translates into millions of potentially corrupted data points.
That are feeding these incredibly complex quantitative models. It adds up. And they're not always random errors.
What do you mean?
Some of the errors they found were directly linked to liquidity-driven price errors where the recorded price was artificially skewed.
Just because of low volume or weird execution stuff, but the complexity just explodes when we get to corporate financial reporting.
You're talking about the XBRL filing discrepancies?
Yes. So when companies started filing their financial data using this new digital standard, XBRL, researchers compared the facts in traditional databases like Compustat to this new interactive data.
And what did they find?
The results were startling. Only 44.3% of the financial facts matched exactly.
Less than half. Less than half. 4.8% were outright mismatches. They just had different values.
So that's almost 50%. What happened to the other half?
Over 50% were outright omissions in Compustat when compared to the interactive filing data.
More than half the financial facts the company actually reported were just not there. They were missing from the commercial database that everyone uses.
Over 50% omissions. That is catastrophic for any historical analysis.
If half of my balance sheet data is missing for any given year, how can I possibly trust my backtesting results? For risk modeling, for valuation.
You can't.
It means any model that was trained on this historical data is fundamentally incomplete.
It's probably biased towards the, weird, incomplete information it did get.
It creates enormous uncertainty. And on top of that, you have the huge issue of survivorship bias.
If you're studying returns over a long period using a historical database, you have to make sure that the firms that were delisted are still in your sample.
The ones that failed or got bought out or went bankrupt, right?
Because if you only include the firms that survived the entire period you're studying, your entire data set is skewed towards success.
You get this overly optimistic picture of market returns because you're only studying the winners who live to tell the tale.
You're ignoring all the bodies. You're ignoring all the bodies.
And to make it even worse, the historical data itself isn't even static.
Our sources pointed out that if you download historical analyst stock recommendations from a database, say, today, and then download the exact same historical data a year from now,
It'll be different. There can be substantial differences.
because they're constantly making revisions, deletions, additions to the historical records.
The Historic the Truth.
Hey, yeah, what's up?
So, guys, speaking of telling tales, I think it's time to read the messages from our listeners.
You are absolutely right.
Okay, let's take that break.
Thank you so much for the perfect transition.
We did promise we would pause right here.
The historical truth we were just discussing is constantly shifting under your feet.
Oh my God. It's like finding out your... Oh yeah, let's hear it.
Okay, so first message is from Julian K. in Berlin, Germany. He said, "Hi guys, longtime listener, first time pen pal. My dating life lately feels less like a romantic comedy and more like a high frequency trading desk. Lots of noise, rapid execution, and absolutely zero long-term settlement. I've noticed my current flame's texting habits have a higher standard deviation than the crypto markets in 2021. If I want to hedge against the risk of him ghosting after the third date, should I be buying deep out of the money put option on his interest level? Or is it the ghosting already priced in? Also, does the Black Scholes model have a Greek for emotional unavailability? So yeah, ich liebe Berghain gern. Thank you, danke. Julian K. from Berlin, Germany.
Okay, Julian, we love this.
Julian, this is peak financial liturgy meets dating chaos.
This is exactly the messy energy we needed for this break.
And we're going to unpack this high-frequency dating desk situation.
You absolutely nailed the analogy of dating as high-frequency trading.
Lots of noise, rapid execution, zero long-term settlement.
It's all about intraday volatility, baby.
When you talk about their texting habits having a high standard deviation, you were using the math correctly.
High volatility in texting means high risk of an unexpected outcome.
And that standard deviation is treating both the huge positive surges and the sudden silences equally.
But what you really fear is the downside deviation, the silence, the ghosting.
So remember the concept of semivariance we discussed earlier?
You should be looking at the semivariance of his interest level.
That measures only the variability below your personal average interest threshold.
It's the metric for fear, Julian.
Now onto your hedge, buying a deep out-of-the-money put option.
That's a fascinating idea because options are all about the nonlinear payoff.
A put option gives you the right to sell something at a certain price, the strike.
In your dating analogy, the put is a contract to profit if his interest level drops below the strike price.
A deep out-of-the-money option is cheap, but it only pays out in a catastrophic event.
Ghosting is catastrophic, so that deep OTM put is your cheap insurance policy against total emotional loss.
It limits your maximum downside risk, your premium, but gives you potential payoff if the market really crashes.
And is the ghosting already priced in?
Well, in a highly speculative market like the crypto dating scene, there should be a risk premium.
But information asymmetry means it's likely underpriced.
If you, the informed trader, know he's prone to ghosting, you have an edge.
You're acting like an informed participant in a flawed market.
Finally, back to our listener. What's up?
Okay, so the next message is from Ravi M. in Mumbai, Maharashtra, India. He said, "Namaste team. I'm currently navigating a throuple situation, and frankly, it's a portfolio optimization nightmare. I'm trying to find the efficient frontier of my Saturday nights. Partner A offers high returns in the bedroom, but comes with massive tail risk. He's a drama king. Partner B is a low volatility, steady yield snuggler, but has very little market depth when it comes to conversation. How do I calculate the optimal weights for my affection without suffering a total diversification decay? Is there a Lagrange multiplier for three-way dinner reservations?
Namaste, Robbie. We are absolutely living for this portfolio optimization nightmare.
This is a spectacular expansion of our risk and return discussion.
You've perfectly framed this as finding the efficient frontier of your Saturday nights.
Partner A, the drama ting, is your high return, high risk asset.
He's got the massive tail risk, the volatility, and the potential for huge upside.
Partner B is your low volatility, steady yield snuggler. That's your risk-free asset, honey.
Or at least your low-risk asset. The key here, Robbie, is the concept of diversification benefit.
You want to combine these two assets, A and B, in a portfolio.
And ideally, that combination should have a better risk-return relationship than either A or B alone.
The potential for diversification decay you mentioned relates directly to correlation.
If A and B's returns or pleasure move perfectly together, their correlation is 1.
And then adding B to A doesn't reduce the total portfolio risk, that's decay.
But if they have a low or even negative correlation, the portfolio's overall standard deviation, or drama, will drop significantly.
The trick is finding the right weights for your affection. That's the core of portfolio management.
You are seeking the optimal weight that maximizes your utility.
This depends entirely on
Okay, so the next message is from Marcus T. in Toronto, Ontario, Canada. He said, "Hey Pod, I've been seeing this guy who is a total 10 on the fundamental analysis side, but his technicals are a mess. We're talking about moving in together, but his credit score is basically junk bond status. I'm worried about a contagion effect on my own balance sheet. If we co-sign a lease, am I essentially providing him with an uncollateralized credit default swap on his lifestyle? At what point do I stop buying the dip on his potential and just initiate a total liquidation of the relationship?" Basically, Marcus T really said, what about it?
Oh my God, Marcus T.
What a booted. This is a masterpiece.
Marcus, this is the perfect question to bring us into Act 4.
Yes, because you were asking about the catastrophic power of leverage and default.
And the essential vetting process, the 5 C's of credit analysis.
Let's start with your guy's fundamentals versus his technicals.
Fundamentals are his intrinsic qualities, his potential.
His technicals, the junk credit score, is his character, which is one of the 5 C's.
Character is his track record. It shows the likelihood he'll actually repay.
A low FICO score indicates a higher default probability.
This directly relates to the capacity C as well.
If he has a low score, it suggests his debt to income, or DTI, ratio is probably too high.
He can't afford his lifestyle, regardless of his potential.
Now, your concern about the contagion effect on your balance sheet is spot on.
If you co-sign a lease, you are now providing the collateral.
You are leveraging your own good credit score, your capital, to secure his ability to borrow.
You are providing the security the landlord demands because his own credit score isn't enough.
And you asked if you are providing an uncollateralized credit default swap.
In a way, yes. A credit default swap, a CDS, is insurance against a credit event.
You are the insurer. You are taking on the credit risk of the probability that he defaults.
And since his collateral is non-existent, you are providing him an uncollateralized guarantee.
The problem isn't just a loss of money, it's the systemic risk to your own financial ecosystem.
If he defaults, your credit score suffers immediately.
That contagion effect is real. It raises your own cost of borrowing for years.
Finally, the liquidation question. When to stop buying the dip on his potential?
This is a risk management question. You are currently in a highly leveraged position,
Leverage is that high glamour look that is absolutely stunning on the way up.
but sends you home totally broke and cry. Oh yeah, let's hear it.
Okay, so this would be the final question. After this, I'm gonna let you guys have the full floor. Okay, so this is from Mateo S. in Sao Paulo, Brazil. Oi! I'm writing in because I'm experiencing a major liquidity crisis, and I'm not talking about my brokerage account. The local dating pool is currently as dry as a frozen credit market. My bid-ask spread is huge. I'm looking for a long-term investment, but the market is only offering overnight repos. Should I lower my ask price to attract more bids on Grindr, or would that just lead to a long-term devaluation of my personal brand? How do I stimulate some quantitative easing in my bedroom?
Mateo, thank you for closing out our listener questions with this masterpiece.
Oi. We are immediately filing this under major liquidity crisis.
You are describing the fundamental problem of quantity discovery in an illiquid market.
That wide bid-ask spread you mentioned is the technical receipt.
It perfectly signifies that the market is struggling to agree on a price for the asset you.
Your ask price is where you are willing to sell your time, maybe for a long-term investment.
Your bid price is the highest price the market is currently willing to pay just for an overnight repo.
The huge gap, the spread, means there's a severe lack of agreement on your true value.
And the market is offering only overnight repos.
That's short-term financing, like borrowing for just a day or two, reflecting minimal commitment.
That's because the market you're in Sao Paulo is acting like an off-hours, non-transparent trading facility.
Like a dark pool where big traders hide their orders, leading to high friction.
So, to your question, lowering your ask price.
That might attract more bids and increase the volume traded, which is one way to assess liquidity.
It will tighten the spread, making the market look more liquid immediately.
But you are right to worry about the long-term devaluation of your personal brand.
If you constantly lower your ask, the market may adjust your perceived intrinsic value downward permanently.
You're sacrificing long-term value for short-term execution.
This relates to the concept of market impact.
If you aggressively enter a large sell order lowering your ask significantly, you can drive the price down.
The price concession you make for trading in size is the market impact.
You want to avoid that price concession here because it hurts your brand.
Instead of lowering the price, you need to stimulate liquidity making.
You want to attract patient, long-term limit orders from stable counterparties.
They are the ones who provide the depth and breadth needed for a healthy market.
Finally, quantitative easing in the bedroom.
That's a macroeconomic policy to increase the money supply.
In your case, it means injecting confidence and increasing the perception of value in your market.
You want to enhance your fundamental analysis, your intrinsic qualities.
And patiently wait for the market conditions C to improve.
Do not panic sell. Hold your price.
You have the right to liquidate when the risk premium on his potential no longer compensates you for the risk to your own balance sheet.
That is the ultimate test.
Thank you for this perfect high-stakes question, Matteo.
Now, back to Marcus's liquidation question. When to stop buying the dip on his potential?
This is a risk management question. You are currently in a highly leveraged position.
Leverage is that high glamour look that is absolutely stunning on the way up.
But since you're home totally broke and crying in the Uber when the market dips.
He is a highly volatile, high leverage asset. You must decide if his potential upside is worth the catastrophic downside risk to your capital and character.
You're trying to find the blend that gets you to the highest indifference curve possible.
That curve represents the trade-off you are personally willing to accept between risk and return.
You have the right to liquidate when the risk premium on his potential no longer compensates you for the risk to your own balance sheet.
So, Marcus, we suggest a full-on 5Cs assessment immediately.
Now back to Robbie's earlier optimization query, before Marcus's and Matteo's important interjections.
The complexity of finding that optimal portfolio.
The trick is finding the right weights for your affection. That's the core of portfolio management.
You are seeking the optimal weight that maximizes your utility.
This depends entirely on your own risk aversion, like Sam and Rachel in our earlier example.
The more risk-averse you are, the higher the weight you put on the low-volatility snuggler, partner B.
The less risk-averse, the more weight you can put on the high-return drama king, partner A.
You want to find the blend that gets you to the highest indifferent curve possible.
That curve represents the trade-off you are personally willing to accept between risk and return.
And as for the Lagrange multiplier for dinner reservations?
The Lagrange multiplier is a math tool used in optimization problems with constraints.
In finance, it helps us find the optimal portfolio under the constraint that all your weights must sum to 1.
So yes, you could absolutely use the Lagrange multiplier to find the optimal three-way dinner reservation.
But only if you clearly define your objective function and your constraint. You only have one table.
It's all about harmonizing your utility trade-off with what is possible in the market.
Thank you, Robbie, for that beautiful and highly technical question.
And back to Julian's excellent option query from earlier.
We were just about to discuss the Greek sensitivities.
Finally, the Greeks. Gamma, theta, delta, and vega are the sensitivities of the option price.
Does Black-Scholes have a Greek for emotional unavailability?
It does not, unfortunately.
But the option Greek, vega, might be close.
Vega measures an option's sensitivity to volatility in the underlying asset.
A high vega means the option value soars when the underlying asset, his interest, is incredibly volatile.
His highly volatile texting habits are your vega play, Julian.
That emotional unavailability increases the risk, making your put option theoretically more valuable.
So we suggest a low premium, high vega strategy.
And thanks for the beautiful sign-off, Julian.
We've covered the complexity of that high-frequency data drama.
Which brings us to Act 3, the library is open.
Which makes our next act, trying to build predictive models, incredibly challenging.
Given those data quality issues we just discussed.
Okay, so since the raw financial numbers are so messy and frankly unreliable. The quants are turning to text.
They're looking at news sentiment, annual reports, regulatory filings, trying to find the truth in the words.
We are now entering the high-glamour world of advanced math designed to reduce all that chaos.
This really starts with vector semantics and something called embeddings,
The basic approach is to represent a word not as a discrete symbol.
but as a dense vector, basically a point in a multidimensional semantic space.
Okay, what does that mean in English?
It means a word's meaning is mathematically derived from the words that usually appear around it.
It's context.
So if words like leveraged, risk, and default frequently show up near each other in financial news,
Their vectors will end up clustered closely together in this high-dimensional space.
precisely, this allows the model to capture really subtle semantic relationships.
And these dense embeddings, they typically have between 50 and, say, 1,000 dimensions.
1,000 dimensions. You can't visualize that.
You absolutely cannot. But we can use techniques to project them down to 2 dimensions to see those clusters.
You could project it down and see that, CEO and CFO are close together.
Well, watermelon is very far away.
Okay, so how do we quantify that relationship?
If I have 2 of these vectors, how do I know if they're a perfect match?
We calculate the cosine similarity
It's a metric that measures the similarity between 2 vectors.
by calculating the cosine of the angle between them.
What's the scale of compatibility here?
The value ranges from -1 to 1.
A cosine value of 1 means the vectors point in the exact same direction.
They have perfect semantic overlap. They're interchangeable in that context. A perfect match.
A perfect match. A value of 0 means they're orthogonal perpendicular, no relationship.
And -1 means they're similarly opposed,
This metric lets models quantitatively search for these textual relationships.
which is vital for analyzing things like corporate sentiment.
This math is so elegant, but we just spent an entire act talking about how biased and flawed our historical data is.
So what happens if we train these powerful embedding models on text that reflects our systemic biases?
Like, gender inequality in the workforce.
That is a major, major ethical and practical concern.
Because embeddings don't just passively reflect the biases that are present in the text you feed them.
They can actually amplify them.
What? How?
Researchers compared the magnitude of bias in the embedding space to actual labor employment statistics.
They found that gender terms became more gendered and more exaggerated in the model.
Than they were in the real-world data it was trained on.
The model is acting like a funhouse mirror.
It's taking our existing flaws and making them cartoonishly worse.
This has huge implications if these models are being used for, like, automated hiring or credit underwriting.
Exactly. They could exaggerate historical biases against protected groups, leading to really unfair outcomes.
Understanding that bias amplification is essential.
You have to use mitigation techniques to make sure these sophisticated tools don't just make historical injustices even worse.
And that need for fairness and transparency is exactly why policymakers are often really cautious about this kind of machine learning.
If you're the U.S. banking regulator, you need to be able to explain why a model made a specific decision.
Like why someone's credit application was denied, right?
You have a legal obligation to tell the borrower the reason.
So even if some incredibly complex deep neural network offers marginally better predictive performance,
Regulators might prefer a more transparent method. Absolutely.
if the performance between competing supervised learning algorithms isn't dramatically different, then transparency and interpretability become the most important things.
This is why models like the decision tree are so crucial.
Okay, so how does a decision tree give you that kind of clarity?
Decision trees are non-parametric models that classify things through a series of logical binary questions.
The model just keeps partitioning the dataset based on simple rules.
Is the borrower's debt-to-income ratio greater than X?
If yes, you go down one branch. If no, you go down the other.
So it's like a flowchart, a transparent, sequential process that ends at a leaf or a terminal node.
And that terminal node gives you a classification probability, say, low, medium, or extreme risk.
And because the path is totally visible, you can see exactly which rules led to that classification.
It satisfies the regulatory need for interpretability.
And these kinds of models are vital for analyzing data that moves really fast, like in nowcasting.
GDP, for example, is only reported quarterly, but we can't wait 3 months to figure out if we're in a recession.
Exactly. Nowcasting is just predicting an economic indicator, like GDP, in near real time.
To do it, economists decompose GDP into its components.
Consumption, investment, government spending, and net exports.
And how do they speed up the data input for that?
They blend the traditional hard economic data, which is often lagged and low frequency, with high frequency alternative data.
For instance, the trade component, net exports, can be now casted by analyzing daily shipping data from global ports.
So instead of waiting for the official government trade stats, they are literally monitoring the real-time flow of goods around the world.
That's exactly right. There are companies that analyze this alternative data stream,
They incorporate text-based indicators from news and shipping manifests.
and they create these indexes that track the evolution of global trade on a daily basis.
It gives policymakers a leading signal long before the official statistics come out.
So when we move to reducing complexity in really large data sets, we have to rely on some heavy-duty linear algebra tools.
Specifically, singular value decomposition, or SVD.
Okay, that sounds like the financial equivalent of a really high-power Instagram filter.
It takes a complex, messy image and just reduces it to its core elements.
That is a perfect way to describe its function.
SVD approximates a large matrix with a smaller, lower rank one, while mathematically preserving most of the information.
It's fundamentally a dimension reduction technique. It finds the underlying structure in the data.
And the related technique, principal component analysis PCA, applies this beautifully to one of the most complex things in all of finance.
The U.S. Treasury yield curve.
The yield curve plots the interest rates of U.S. Treasury bonds across all these different maturity dates.
From 3 months out to 30 years.
And its behavior is incredibly complex because all of those points move together, but also independently. It's a lot to track.
It is. So PCA to break down the movement of all those different maturities into just a few key components.
That explain almost all of the variance.
So instead of tracking dozens of maturities, we can just track, 3 primary factors? What are those factors?
The analysis finds that 99% of all the movement can be explained by just 3 principal components.
The first one, PC1, is correlated with the level of the curve.
That's just all the rates moving up or down in parallel.
Okay, that makes sense. The whole thing shifts. What's the second one?
PC2 is highly correlated. Our sources say 97% correlation with the tilt of the yield curve.
The tilt is the slope, the difference between long-term and short-term rates.
So when the curve inverts, when short rates are higher than long rates, that's the PC2 moving.
Exactly. That inversion is the famous signal of an impending recession. So PC2 is basically the recession indicator.
And what does PC3 capture?
PC3 captures the change in the curvature of the yield curve.
So that's the bow or the hump you see in the middle of the curve.
By tracking just those 3 factors, level, tilt, and curvature, analysts can simplify this massive, complex, high-dimensional data set
into a few elegant, intuitive factors. It makes modeling and risk management so much more efficient.
Okay, we've established the math, we've dissected the models, but now we enter the most dramatic act of all.
The realm of high-stakes financial risk, default, and catastrophic failure.
This is where the music swells, honey, and the whole system can collapse.
It is, and before any money is ever exchanged, a lender has to assess credit risk.
That's just the probability that the borrower will fail to meet their full obligation of principal and interest payments.
It is the essential vetting process.
And finance has a whole system for this, doesn't it?
It's often broken down into the 5 C's of credit analysis.
Lay them out for us. This is like the financial background check you do before you get into bed with someone.
It really is. We just touched on them with Marcus and Matteo.
Capacity, capital, character, collateral, and conditions. Every single one of them.
Capacity is the borrower's ability to repay the loan from cash flow.
Capital is the borrower's own wealth, the buffer for unexpected events.
Character is the credit score and track record, which Marcus's guy is failing.
Collateral is the asset securing the loan, and conditions are the terms of the loan itself.
Every single one of those is designed to minimize the lender's exposure to default.
It's a full-body scan of the borrower's reliability.
Now we have to discuss the single most destructive force in modern finance when things go wrong.
Leverage. Leverage is just the use of borrowed money debt to finance assets.
It amplifies your returns, which is great, but it also amplifies your losses catastrophically. How do we quantify it?
A key metric is the equity multiplier, which is calculated as assets divided by equity.
And since a company's assets are always equal to its liabilities, which is debt plus its equity,
The formula makes it really obvious.
the more debt you have, the higher your leverage ratio.
So why is that amplification so catastrophic when the market turns against you?
I mean, the math is just brutal. Imagine a firm with 10-to-1 leverage.
If the asset they bought with that borrowed money drops by just 10%, that's a 100% loss of their equity.
They're wiped out completely. If the leverage is 20-to-1, a 10% drop results in a 200% loss. Instant bankruptcy.
Leverage is that high glamour, show-stopping look that is absolutely stunning on the way up.
But sends you home totally broke and crying in the Uber when the market dips.
And you can get this catastrophic leverage not just through corporate debt, but also through financial instruments like derivatives.
Absolutely. Options, specifically call options on a stock, provide immense leverage through what's called a multiplier factor.
For a relatively small premium, one single contract can control 100 shares of the underlying stock.
So a tiny move in the stock price leads to a huge leveraged change in the option's value.
A much larger change. You get maximum exposure for a fraction of the capital cost.
And this concept of leverage through options actually helps us model mortgage default.
Especially in the lead up to the 2008 crisis.
How so?
In a non-recourse mortgage environment where the lender can't come after your other assets if you default.
The homeowner is essentially holding a call option on the value of their house.
The strike price of that option out of their mortgage debt.
Okay, so if the house value goes up above the debt, the homeowner profits.
But if the value falls below the debt,
They can just choose to default. By defaulting, they're exercising their option to put the loss back onto the lender.
their own personal downside risk is limited to whatever equity they put in at the beginning. It's a free option for the borrower.
That's insane. It is.
And as our sources confirm, these free options invite massive speculation.
They are a powerful mechanism for inflating asset bubbles because they socialize the losses while privatizing all of the gains.
And these free options and massive leverage, they only exist because of these fundamental market flaws.
Information asymmetry and moral hazard.
Regulation has to exist because, left to their own devices, people will inevitably over-speculate and make some very messy ethical choices.
The problem really blows up when incentives are severely misaligned.
Just consider a highly compensated trader who is out of the money for the year.
They've already lost money for the firm. They're probably going to get fired.
So their job is already on the line. Personally, they have nothing left to lose.
That trader now has a powerful incentive to take massive, highly leveraged, probably unauthorized risks.
If they get a huge win, it puts them back in the money. They save their job, they get their bonus.
And if they have a huge loss.
A huge loss is catastrophic for the firm, but it doesn't dramatically worsen the trader's personal outcome. They're already getting fired.
The firm bears all the risk. That is a stark moral hazard.
And the systemic failure there isn't just the math, it's the lack of controls.
The most famous example of this kind of breakdown has to be the Kerviel catastrophe.
Jerome Kerviel, he was a trader at Societe Generale.
He fabricated emails, he hacked into the firm's surveillance system, all to hide billions in unhedged, leveraged positions.
When the market moved against him, the losses total $7.2 billion. $7.2 billion.
It wasn't a failure of market forecasting. It was a devastating internal failure rooted in a complete lack of checks and balances.
And a system that failed to flag the enormous exposure of a single rogue actor.
And these spectacular failures, they often lead directly to systemic regulatory change.
Our sources point all the way back to the collapse of a bank called Bankhaus Herstatt in 1974.
Herstatt was a relatively small German bank that collapsed in the middle of the business day.
And it caught its counterparties in the foreign exchange market mid-transaction.
Because of time zone differences and really poor international supervision?
Some banks paid Herstatt in one currency but never received the corresponding currency back.
It was a failure of settlement, proving that a lack of finality can tank the whole system.
This has been The Deep Dive.
We've covered everything from TVM to catastrophic moral hazard.
And thank you, Marcus, Julian, Ravi, and Matteo for your amazing questions.
Thank you so much for joining us for this high-octane ride.
We'll see you all the next time for another Deep Dive.
Goodbye, everyone.
Louisiana Sea. Gitchy, gitchy, da. Gitchy, gitchy, heat tonight in Nagasaki. On the Keys for the Rice Queens. Enola Gays, Louisiana Sea. Gitchy, gitchy, da. Gitchy, gitchy, heat tonight in Hiroshima.